Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we'll explain how to invest in the Nasdaq 100 ETF, QQQ, and share tips to get started. Market volatility and economic downturns. Tech stocks don't always weather economic storms well. Rising interest rates, inflation, or recessions can hit growth companies harder than stable, cash-flowing businesses. For example, rate sensitivity. Higher interest rates make borrowing costlier for tech firms, which often rely on debt to fuel expansion. This can slow growth and pressure stock prices. Recession risks. Consumers cut spending on gadgets and streaming services first when budgets tighten. That affects companies like Apple and Netflix more than groceries or healthcare providers. QQ's past resilience doesn't guarantee it'll bounce back quickly in every downturn. If you're investing for the long term, short-term drops may not matter. But if you need stability or plan to cash out soon, this volatility could be a concern. The key takeaway. QQQ offers growth, but it's not a set-it-and-forget-it fund. Pairing it with less volatile assets can smooth out the ride. How to invest in the Nasdaq 100 ETF. Investing in the Nasdaq 100 ETF, QQQ, is straightforward, but doing it the right way can save you money and set you up for long-term success. Whether you're a first-time investor or adding to an existing portfolio, these steps will help you get started. Choosing the right brokerage. Picking the right brokerage platform can make a big difference in costs and ease of use. Here's how popular options stack up. Fidelity offers commission-free trading, robust research tools, and strong customer support. Great for hands-on investors who want detailed analytics. Robinhood. Simple interface with no account minimums. Ideal for beginners but lacks advanced trading features. Charles Schwab. Low fees, fractional shares, and a wide range of ETFs. Best for those who want a mix of self-directed and managed investing. E-Trade. Solid educational resources and a powerful trading platform. Suits investors who want both guidance and control. Compare fees, like spreads or commissions, and check if the platform offers fractional shares if you want to invest smaller amounts. Some brokerages also provide auto-investing tools, which can streamline dollar cost averaging. Investment strategies for the Nasdaq 100 ETF. Once you've picked a brokerage, decide how you'll invest. Here are 3 common approaches. Dollar cost averaging, DCA. Invest a fixed amount regularly, e.g., $500 per month. This reduces risk by smoothing out price swings over time. Long-term holding. Buy and hold QQQ for years to ride out short-term volatility. Reinvest dividends to compound growth. Tactical allocation. Adjust your QQQ position based on market conditions. For example, trim exposure during tech sell-offs and add during dips. No single strategy works for everyone. If you're unsure, start small and gradually increase your position as you get comfortable. The key is consistency. Whether you invest weekly or quarterly, stick to your plan. Most brokerages let you place orders in minutes. Just search for QQQ, enter the number of shares or dollar amount, and confirm the trade. Keep an eye on bid-ask spreads, especially if trading large amounts, as narrower spreads mean lower costs. With QQQ, you're not just buying a fund. You're buying a piece of the world's leading innovators. Choose the right tools, stay disciplined, and let time do the heavy lifting. Comparing the Nasdaq 100 ETF to other investment options. If you're considering QQQ, you might wonder how it stacks up against other choices like broad market ETFs or individual tech stocks. Each option has trade-offs, so let's break them down to see which fits your goals. QQQ versus S&P 500 ETFs. QQQ and S&P 500 ETFs, like SPY or VU, both offer instant diversification, but their performances and risks differ sharply. Performance. QQQ leans heavily on tech and growth stocks, which often outperform during bull markets. Over the past decade, QQQ's average annual return beat SPY by about 6%. However, in downturns or when value stocks lead, S&P 500 ETFs tend to hold up better. Sector exposure. The S&P 500 spreads risk across 11 sectors, including stable ones like utilities and consumer staples. QQQ skips financials and utilities, leaving it more exposed to tech's boom and bust cycles. Risk profile. SPY's broader mix makes it less volatile. If you want steady growth with fewer surprises, the S&P 500 wins. If you're betting on tech's long-term dominance, QQQ's concentration pays off. Short-term traders might prefer QQQ's volatility for bigger swings, while buy-and-hold investors often blend both for balance. QQQ versus individual tech stocks. Picking stocks like Nvidia or Apple can deliver explosive gains, but QQQ offers a safer path. Diversification. Owning QQQ means you're spread across 100 companies. If one stock crashes, like Meta in 2022, others can cushion the blow. With individual stocks, a single bad earnings report can wipe out gains. Effort. Researching and monitoring stocks takes time. QQQ handles rebalancing for you, so you don't need to track CEO changes or product flops. Cost. Buying 10 tech stocks could mean 10 trading fees, unless your broker offers free trades. QQQ bundles them into one purchase with a low 0.20% fee. That said, individual stocks can outperform during rallies. If you'd picked Microsoft in 2010, you'd have crushed QQQ's returns. But most investors lack the time or skill to pick winners consistently. QQQ simplifies investing in tech giants while reducing risk. For hands-off investors, that's a win. The Nasdaq 100 ETF, QQQ, gives you exposure to top-tier companies like Apple, Microsoft, and Amazon in a single trade. Its low fees, liquidity, and growth potential make it a standout for investors betting on tech and innovation. But its heavy tech weighting also means higher volatility. When tech stocks dip, QQQ feels it harder than broader market funds. Before jumping in, think about your risk tolerance and goals. If you want steady long-term growth and can stomach some ups and downs, QQQ could be a smart addition to your portfolio. Pairing it with more stable assets like bonds or S&P 500 ETFs can help balance risk. Ready to take the next step? Talk to a financial advisor to see if QQQ fits your strategy, or explore resources on dollar cost averaging to smooth out market swings. Whatever you decide, staying informed is the best way to invest with confidence. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.